Hey everyone, and welcome back to our monthly market commentary. This is the May 2025 edition. My name is Brad Gotto, the CEO and founder of Fiat Wealth Management. And here with me, as always, is my friend and colleague, Mr. Tim Holland, the Chief Investment Officer of Town Square Orion. This is your first ever monthly market commentary. Tim and I, every single month, get together and we, for the most part, unless there's extenuating circumstances, kind of follow a pattern of taking a look back over the last month and just talking about what happened over the last month. We try to take a look ahead of what's coming in the coming month that we need to be paying attention to, and then just try to always end with something a little bit fun, kind of a data point that's worth discussing, we like to call it. And so let's start at the beginning, a look back. I'm calling this point, Tim, to tariff or not to tariff.
Okay.
That is the question. This is as close as I get to Shakespeare. So here we go.
The Bard. Well
I
done.
don't have to
Yeah.
say too much else because if unless your head has been in a hole or in the
Yeah.
sand, so to speak, for the last couple of months, we all know
Yeah.
this give and take, yin and yang, coming out of the White House of tariffs. Okay, pause. No, we're back on. Just kidding.
Yeah. Yeah.
Kind of
Yeah.
where are we at over the last month as it relates to tariff and kind of tariffs,
Yeah.
and how has that gotten us to where we're at today?
Yeah. No, that's the big question. And you're right. It does kind of move day to day and change day to day. So, as you know, right, April 2nd was Liberation Day. And as always, we're not here to play politics or pick sides. We're just trying to understand where the policy winds are blowing and what that
Yep.
might mean for the portfolios we've been entrusted with. And so Donald Trump comes out April 2nd, announces, if memory serves, a 10% baseline tariff and reciprocal tariffs on just about every country we do business with. And then there was a very quick back and forth with China that escalated quickly, where I think our broad tariffs on China are at 145%. They're at 125%. Obviously, we run a big deficit with them, so it's probably a much bigger deal for them. And markets sold off dramatically. The S&P gave back about $7 trillion in market cap that Thursday and Friday after Liberation Day. It was the biggest two-day drop in the history of the index. Markets at one point, the S&P was off 21% from its all-time high intraday, but
Yeah.
didn't close down 20% plus. So we're technically not in a bear market. And just for the month of April, the markets were off about 14% peak to trough. But then a few days later, the president came out, to your point, announced a 90-day pause on all reciprocal tariffs ex-China. Baseline tariff went into effect, and then the markets just ripped. And here we are with the S&P off about 4% year to date, and well off its lows for the year. And the latest news is the U.S. and China will meet up in Switzerland, and we'll dig into this. So I think until we get some clarity, we're all sort of going to be impacted at what the narrative is from the White House. We do think deals will get done. We're optimists at heart. If I was a betting man, and I'm not, I would think the next bit of news is something with the EU or Japan or India, something consequential. And in the background, the Republicans in Washington, D.C. are still trying to move the tax cut ball down the field. So I do think some good news is coming, but we're going to have to continue to live with this volatility, I think, until we get some good news and some clarity. But the markets are doing okay. The economy's hanging in there. And the final point I'd make, and I'm not trying to pick a fight with the president, he knows things have gotten better, right? And if you're a really good negotiator, and I am a terrible negotiator, when you have a better hand or a good hand. So markets have ripped. The bond market's behaving itself. And what happens a couple of days ago, the president says we're going to have a big tariff on all movies made outside the U.S. So I think we have to remember that maybe when the markets stumble, the administration becomes a little less aggressive. And I think when things are up and to the right, they know they can probably press their bets a little bit more. So that's where we are. We're waiting on news. I think we'll get it. And if I was, again, a betting man, I think the next bit of news is good, not bad. But it's been an interesting couple of weeks for sure.
It does. I love the analogy that you use because it does feel like that. If you've ever played Texas Hold'em, you know that there's kind of a game to be played before any community cards even come out. There's kind of a whole separate game to be played once you have your flop, as they call it, a whole nother game after the turn and a whole nother game after the river, as far as betting and kind of trying to figure and play this out. And I feel like we're in the
Yeah.
middle of a poker hand
Yeah.
and nobody really knows what anybody else has and where they're going to stop betting And here we sit in the middle of it. But there is good news in all of that. The good news is you mentioned the economy seems stable at this
Yeah,
point in spite of the uncertainty. And the other thing that I would just point out to all of you who are listening is if this has highlighted anything recently or put, kind of a microscope on or a ray of sunshine on anything, it is diversification.
yeah,
Because while since 0809, yes, we've had our bumps in the road since the major financial crisis, multiple, but on the whole, the markets have been amazing
yeah,
and been pulled forward and led by large US stocks in the Magnificent Seven more so than any of them, right?
yeah,
So, but recently, the parts of the portfolio that are holding up now that the storm has hit, the things that are kind of keeping the foundation together are not the large American companies. It's our fixed income, it's our value paying stocks, or dividend paying stocks, rather, and our international holdings, which, quite frankly, have been very underwhelming for more than a decade.
yeah,
Yet here, it's those parts of the portfolio that maybe over the last 3 years as an investor, Tim, you're like, why am I in this stuff?
yeah,
And it's hard to make those disciplined decisions in moments where you see stocks like Nvidia doing what it's done over the last 5 years, or just any of you know your S&P, like just your
yeah,
SPY versus the rest of your portfolio. Yet here we sit, and it's paying off.
yeah.
Tortoise in the hare, right?
Tortoise in the hare.
Tortoise in
Yeah,
the
yeah.
hare. So
Slow and steady wins the race. No, that's a great point. Great point for
um,
sure.
there's definitely things to be positive, or to feel positive about. And I
Yeah,
think the most important point in all that, and I'll say it one more time for emphasis, is you brought up the point that the economy seems to be doing, fairly well. A lot of the
yeah,
data coming out is pointing towards that we're maybe not running as hard as we would want, but it's definitely not going terrible
yeah.
in spite
No,
of all the uncertainty. So
the resiliency of the U.S. economy and the U.S. consumer. I don't know why I'm always astounded by it because I've just seen it so many times,
yeah,
but I'm always astounded by it. And I so there's uncertainty, but to your point, the resiliency is there. The economy is doing well, and if we can get some certainty, then you sort of start to unlock some potential spending again and investments. But yeah, no, the never bet against the U.S. consumer. I learned that a long, long time ago. And
yeah.
I like the Texas Hold'em. I didn't know there was a game within a game within a game, which probably explains why I always lose at poker. I'm just so bad at that. Anyway, that was helpful.
Uh,
I'm grateful for that.
the other thing, just one more point I want to make before we go to a look ahead, and you're talking about being an optimist, and I am too. And I think
Yeah,
that to be a long-term investor, to be an investor, which means you're playing a long game, you
yeah,
have to be an optimist,
have to be.
right? If you're the person that is getting in and out of the market, you're not an optimist, you're an opportunist, and that's
Yeah,
different. That's
yeah,
gambling. Optimism in what we're doing here and what we've built as a machine, knowing that it can withstand and has withstood some of the most crazy, economic cycles,
yeah,
and every time this happens, Tim, you can always point to three things that make it different, right?
yeah.
Like,
Oh
what's
yeah,
different this time
oh yeah.
because of A, B, and C.
Yep.
Always true.
Always.
But as an optimist, I'm an investor,
Yeah,
right? I believe in the long-term viability of what we're doing here in the States. Not an opportunist,
no.
at least not when it comes to my financial plan. So
Yeah, well said.
a look ahead. You ever heard that saying? It's the quiet ones you got to watch.
Yeah.
Yeah. What's funny is when I wrote that down, all I could think of is George Carlin. Did you ever listen to George Carlin?
Oh, brilliant. 7 words you can't say on TV. Way back when. I mean, that's from the 1970s, I think, but oh,
One
he
of
was
his old comedy hours,
so
he had a
smart.
joke about this saying. He's like
Yeah.
all these American sayings that he thought were ridiculous. And
Yeah.
one of them was, it's the quiet ones you got to watch. And his joke was, you walk into a bar and you're sitting at the bar next to a guy who's super quiet. And there's a
Yeah.
guy in the corner screaming at everybody that he's going to kill him. Who are you going to watch? The quiet one? I don't think so.
Oh, he
Anyway,
he was
um,
such a talent. Go ahead. Sorry. Yeah, that's brilliant. I don't think so.
yeah, I could go on. There's a lot of sayings that he makes fun of that are actually really funny.
Yeah.
Look it up, everybody. It's probably a lot more entertaining than your monthly market commentary from Brad and Tim. So it's the quiet ones you got to watch. The reason I'm calling it that when we're looking ahead, Tim, is because the only thing that seems to be part of anybody's conversation right now is tariffs.
Yeah.
Like in this whole idea of what's coming out of the White House, we're getting a little bit of headlines and noise about the fact that we're in the middle of a Fed meeting right now.
Yep.
But what I feel like is flying under the radar is we're in earnings season.
Yeah.
And the companies are reporting. In fact, we're about 40% of the companies out of the S&P are reporting earnings. And so because it's not really making headlines, can you talk to us a little bit about what has already been reported?
Yeah.
Good, bad, and different, and kind of what we see coming.
Yeah, no, for sure. And you know, another saying is, right, sort of life is all about expectations. And as you know, companies on Wall Street or companies that trade on Wall Street, you know, typically guide to sort of what they think a quarter would look like in terms of revenues and earnings. And they're smart. They want to sort of underpromise and overdeliver. So typically companies do come in better than what those analysts on Wall Street are expecting in terms of sales and profitability. So there's always that bias, but as we go, to your point, 40% or so through Q1, more companies than on average are beating top line expectations. More companies on average are beating bottom line expectations. So the numbers look pretty good. That's helped some stocks the last couple of weeks, independent of the tariff news. Even on days where the geopolitical risk sort of rises, if the numbers have been good enough, these stocks have caught a big bid, as they say on the street. So from a look back perspective, Q1 looks pretty good. The tricky thing, though, is, right, you know, analysts and investors want to know what CEOs and CFOs are thinking about the current quarter and the rest of the year. And not surprisingly, a lot of management teams are just kind of pumping on the brakes, and they're either giving very limited guidance or giving no guidance at all because of the uncertainty. And if I was running a public company and I had to keep shareholders happy and not to be snarky about it, I had an excuse not to promise anyone anything.
Yeah.
I probably would take advantage of that. But if you look at results so far, they're better than expected and better than what you would expect in any particular 90-day period. And that's pretty encouraging too. The private sector is pretty well capitalized. Balance sheets look pretty good. So again, the resiliency, the ability to withstand the uncertainty of the day, you know, the fact that that's happening isn't that surprising, considering, I think, what a good spot corporate America, broadly speaking, is in.
Yeah.
And how well capitalized the banking system is too. So we can navigate these periods of uncertainty, and it's not surprising, I guess, that we are doing, I think, as well as we are, considering how financially strong sort of the companies that make up the economy are right now.
Yeah. The visual I get in my head when you bring that out or kind of laid that out, Tim, was, and this isn't a promise that it's going to look different. It's not going to look different in the future. But as of today, it's kind of like you're in the middle of the storm. The tornado's going on around you, and you walk downstairs into your basement and kind of check out the foundation, and it's holding.
Yeah.
Right. And you're like, okay, the winds are blowing, but the foundation of what we've built here hasn't cracked yet. Like it's still showing very strong. And so at the end of the day, if you're one of those people that this is bugging you a little bit, losing a little bit of sleep about it, or really worried about what's going on, the headlines thus far are far worse than the reaction, the true reaction from the economy at its core. Some of those fundamentals of the things that drive our country forward seem to be holding pretty strong to this point. And again, I have to say this, that's not a guarantee that means it's going to stay that way. Right. But in spite of what's been going on, some pretty good news coming out of earnings season, which is really good to see. Because obviously, if it would have been the opposite, if you'd have taken the headlines and the tariff uncertainty and then stacked on top of that a really bad earnings season, it could have been, you know, we could be in a bit of a slide.
Yeah, no,
that's
a really good point. No, you're absolutely right. I mean, again, uncertainty, tariff, headlines, geopolitical risk for sure, and then you layer on top of that a bunch of companies that are just missing Wall Street's expectations by a mile. No, that's a very good point for sure.
Yeah, funny enough, it would have absolutely made headlines if that was the case, and that compounding effect would have drove fear. Fear would have pulled the markets back. Yet here we sit, it's actually really good. It's barely making headlines.
And no one's talking about it. Yeah.
And nobody's talking about it. So
good point.
Fear sells, right?
Yeah.
All right, a data point worth discussing. I'm calling this point clouds give way to sunshine. So we kind of led into this a little bit already. But what I want to bring up is there's this, how do you say it? The AAII?
Oh, so it's an acronym or shorthand for the American Association of Individual Investors. And then the survey said is the American Association of Individual Investors Sentiment survey, the AAII sentiment survey.
That's a mouthful.
That's pretty
In
good.
other words,
I did better than I would have thought.
I'm going to say in layman's terms, there's somebody out there measuring how bearish or bullish we feel about our economy. In other words, do we feel positive about it or do we feel negative about it? And there's only been since they've been doing this for almost 40 years, there's only been a handful of times where the consumer sentiment has been bearish or negative by at least 60% of people. That was, I'm going to read these out here. In 1990, happened a couple of times in late 1990 due to the Gulf War. It happened a couple of times. It didn't happen again until 08, 09. And there was a couple of periods in the financial crisis, 08, 09, that it happened. So there's a long gap there. It didn't happen again until 2022 when we went through kind of the inflation shock post-COVID that we had going on. And then right now.
Yeah.
And so it hasn't happened a lot. And so you're like, okay, there's the clouds.
Yeah.
Where's the sunshine? Well, the sunshine is every time this has happened, the following 12 months, stocks have always been higher.
Yeah.
And so maybe I should have called it. How's that saying go? It's always darkest before the dawn.
Darkest before the dawn. Yeah.
Dang it. Can we re-record this whole thing?
If you want to, yeah.
Bottom line is, talk to us a little bit about what this consumer sentiment is about and kind of how that's maybe a leading indicator for us.
Yeah, and if I'm wrong about this, I apologize. But did you tell me you were born in the great state of Nebraska?
How do you remember that?
The
answer is yes. But how do you? Yeah.
I don't know. I got a lot of free time. My kids are grown up. They don't want to hang out with me. I got a ton of time on my hands. So the other bit of news the last couple of days is that Warren Buffett is stepping down as CEO of Berkshire Hathaway. I think he'll remain chairman.
End of an era.
Right. Yeah. Arguably the greatest investor of the modern era. And, lots of quips and wisdom. And one is be fearful when others are greedy and greedy when others are fearful. So to your point, so we hit 60% plus on the AAII sentiment survey, February and April. So far, at least based on the April reading, markets are higher since then. And the idea is, right, it's darkest before the dawn, fearful when others are greedy, greedy when others are fearful. When everyone is kind of on that side of the market boat, the negative market boat, the people are going to sell, have already sold. The people that have capitulated have already capitulated, and you kind of wash out. The market gets washed out, and odds are the bad news is priced in, and you move higher from there. So we'll see. To Brad's point, the AAII has been doing this survey since 1987, and there's only half a dozen times when they've hit 60% bearishness on the markets, and the markets have always been, knock on wood, meaningfully higher. So that's really the idea, right? It's hard to do. We're a social species, we're a tribal species. We don't like to separate ourselves from the group. But if you can, when the world looks really unpleasant and most of the folks in the market are scared, if you can lean in, history tells you that's the time to lean in. So we'll see if we've seen the quote unquote lows for the year, if that was it in April when the markets really, really moved south. But if history's any guide, knock on wood, we have. And I think that sentiment reading is really important and really powerful. I really do.
Yeah. I'll tell you this. I can't believe you remembered where I was born. Number two, I don't remember telling you that. So it's kind of creepy. Number three, 19 years ago, almost 20 years ago, when I was studying for my securities license to be able to be in this industry and do what I do, I don't remember a lot of the day-to-day of that studying. But one thing there's a handful of things that really stood out to me when I was studying that blew my mind. One of them was this theory called the odd lot theory. Are you familiar with this?
Yeah. But go ahead. Yeah.
Watch what the average lay investor does. The day-to-day, you and I type investor. Do the exact opposite and you will make money. Now, I'd never heard of the AAII or this survey, which obviously they had been doing at that point in time because they've been doing it for 38 years and this was almost 20 years ago. But for all intents and purposes, it's usually true that when everybody is running away, that if you run in, to your point, and can lean into it, that there's some opportunities that exist. And everybody conceptually wants those opportunities. Everybody wants to buy when things are cheap. Right? and hopefully sell when they're expensive. It's just really, in a practical sense, hard to do.
So hard to do.
One more piece of positive information I want to give before we sign off here, Tim,
Yeah.
and that is, if you look at the major indices, whether it's the S&P, Nasdaq, Russell 2000, which is small companies, growth companies, Russell 3000, value companies, Russell 3000 value, or you go outside of the United States, you look at the MSCI, or the emerging markets MSCI, or even China, or even dip into things like bonds or commodities, like all these different indices over the last 12 months. If we just zoom out a little bit,
Yeah,
and get away from the last like 3 months, outside of the indice that is watching oil,
yeah,
they're all up, all of
yeah.
them.
Good point.
Small companies, mid-sized companies, large companies, domestic companies, international companies, fixed income, they're all up
Pretty
at
good.
least 2%, if not some of these indices up over 20% over the
Yeah.
last 12 months, inclusive of this volatile last 3 or 4 months. And so at the end of the day, the resiliency of our economy that we've talked about earlier,
Yeah.
coupled with the fact that the short-term volatility, for the most part, in most people's portfolios, hasn't even given back the money you've made on the whole in the last 12 months.
Good
We're
point. Yeah.
still net sitting in a positive position. There's just a lot of things to be optimistic about.
Yeah.
And
For sure.
so that would be my final kind of point, Tim,
Yeah.
to those listeners out there, is to remain an optimist and not an opportunist. I'm an opportunist. I would admit I have a gambling account, is what I call it. I have a brokerage account that I'm buying and selling individual stock positions inside of, but that's the same money that I would go play Texas Hold'em with and probably fare better than you.
Yeah,
It
much
sounds
better.
like.
Yeah, no, I'm done. Whatever gambling career I had has come and gone. Just doesn't. I know I'm self-aware enough to know, yeah, I'm no good at that. So good luck with that, because
Yeah,
I won't be at that table. Or I'll just hand you my money and get up and walk away. That might be the
yeah.
more efficient way to do it.
Said differently, I would tell you this: if you're listening to this and you're working with a professional financial advisor, stockbroker, wealth manager, whatever you want to call us, or a category you put us in, that's not an optimist, I would highly encourage you to find somebody that is, because if you do not believe in the long-term viability of our capital markets, then you probably shouldn't be in them in any
Yeah,
meaningful way anyway,
yeah,
right? You don't get into a marriage just expecting it to fall apart, right?
yeah.
You hopefully have a long-term optimistic mindset when you're getting into that marriage, and that's the way that your portfolio needs to be designed. So
Well said.
that being said, a little bit more of an upbeat monthly market commentary
Yeah,
this month, Tim. Thanks for joining us as always, and for
yeah,
your insights. And also worth noting for those listeners, the things that Tim and his team do, and the people that don't get to be seen every single month, and how they benefit Fiat directly and then indirectly benefit you and your families, is second to none. And so just appreciate you and your team, Tim.
yeah. It's a good group of folks. I'm really lucky to work with them. For sure. Appreciate the kind words, and it's always great to be with you, Brad.
All right, we'll see you in June. Thanks,
All
Tim.
right.